Assalamu alaikum, everybody. Said I'm back again with another YouTube video. I don't know why I look like a ghost, super duper pale. All right, but no, whatever. We will deal with it. Today is going to be, I think, part 8 or part 9. I don't freaking know anymore, guys. Of the trading course. This is the second to last video, so we are actually almost done, thankfully. Hope you guys enjoyed this series so far. If you do, like the video, comment down below, subscribe to the channel. Now, this one is going to be about risk management. Risk management is going to be one of the most important things when it comes to your trading. Now, I'm not going to go on the charts. I'm not going to do a bunch of things. I might open up a couple of web pages, but for the most part, guys, this is going to be a sit down talk video because a lot of what I'm going to say, guys, is not complicated. A lot of what I'm going to say might honestly fall under the realm of common sense. It's just people, for some reason, when it comes to day trading, forget everything and suddenly don't have any common sense. All right. So, risk management, as the name says or states, I should say, is pretty much just managing your risk. Okay. As day traders, we are constantly taking risks. Every single position you open is a risk. Okay. Point blank period. Why? Because you don't know if that position is going to work out. You don't know if you're going to make money. You don't know if you're going to lose money. You don't know if nothing's going to happen and you end up just closing the trade out at break even. You don't know what's going to happen until the position is closed. And so because you don't know, that's the risk. Okay. Now, in order to manage your risk properly, there are multiple things you have to take into consideration. What is your position size? How many pairs are you trading? How many positions open do you have? What is your account balance? What's your asset class that you're trading, etc.? And that seems pretty complicated, but it's very simple, guys. We're going to start off with the most basic part of risk management, which is your position size. Okay, so your position size is going to determine how much money you're going to put into a stock, put into like the lot size you're going to do for forex. Okay, and that's going to determine how much you're going to lose when you lose, or how much you're going to win when you win. Okay, it's all going to be based on your position size. Now, how do you determine the proper position size? Right, you're not just going to throw out numbers willy-nilly. Well, this is where a calculator comes in. All right, so you can find any of these calculators online, and these calculators are going to tell you exactly what your position size should be based on your account balance, based on how much you want to risk, etc. Now, risk percentage per trade. This is extremely important. As a beginner, the maximum amount you should be risking per trade, 1% of your account. That is it. No more, no less. Actually, scratch that. No more, but definitely less. If you want to risk 0.5% because you're not comfortable with 1%, that is perfectly fine. Okay, but 1% should be the maximum. Water break. Every single time I make videos, guys, I don't know why, my throat gets super dry. Anyways, okay, so that is the first aspect of risk management, which is how much of your percentage of the account that you have are you going to be risking per trade? That has to be 1%. Okay, now how do you determine that? Position sizing. How do you determine your position sizing? With calculators. So let me share my screen for a very quick second, and we're going to go into position size calculators. Continue to my FX book. Cool, you guys should be able to see this. So let's say you're a forex trader. Okay, a lot of my fan base is forex traders. I don't want to say fan base, that's weird. Subscribers or forex traders. All right. So this position size calculator, my FX book, you can search it up. Right. You're gonna select the pair you want to trade. GBP odd. Let's say your account size. Let's say you have $1,000 account. Now risk ratio, you're gonna put 1%. Okay, and your stop loss, whatever. Let's say this is based on your stop loss. Let's say you have 20 pips. So you're gonna press calculate and it says 0.08 lots. Now what does that mean? When you're taking a trade on GBP odd and you have $1,000 account and your stop loss is 20 pips, if you want to risk 1% of your account per trade, when you go to take that trade, whether it's a buy or a sell position, you are going to put 0.08 as your lot size. Okay, that is what it means. Now again, you'll notice, guys, all right, when I put it at 10, you'll notice that the lot size is going to increase. Now it's 15, right? You'll notice that when I put it at 50, all right, you're going to notice that it goes to 0.03. Okay, so your stop loss and your position size is going to be inversely correlated. The larger your stop loss, the smaller your position size. Okay, and vice versa. The smaller your stop loss, the bigger your position size. But you'll notice the account balance remains the same, the risk ratio remains the same. So no matter what, if you're taking a trade and you're using these numbers on GBP odd, you will only lose 1% of your account per trade, maximum. Okay, so that is very important, because that is going to make sure you do not blow your account. I see a lot of beginner traders, and what do? They're risking 20% of their account per trade, 50% of their account per trade, because they think, oh, well, I'm not going to make money if I only risk $5 a trade. Yeah, that's the point. You're not going to make money because you have no idea what you're doing. you're going to lose a lot of money. So you have to make sure that you don't lose all of your money, because you don't want to be the guy that puts $500 into his trading account, risks all of it, and loses it. There goes $500 of your hard-earned money. Go work a minimum wage job now for freaking, what, 50 hours now to make that back. That's how you have to think, guys. If you lose $500 on a trade, you have to work 50 hours, most of you guys, to make that back. If you're in the United States, that is. Imagine you're somewhere else. What if you're in freaking, I don't know, Zimbabwe? Okay, so do you want to be risking all of your account on one trade and potentially have it lose? Why would you do that? It makes no sense. Your hard-earned money, you're going to lose it all because you're a gambler. You're not trading, right? Day traders don't risk all of their account per trade, 50% of their account per trade. No, you're gambling. That's what you're doing. Okay, that's what sets us aside from gamblers. Risk management, risking 1% of our account per trade maximum. And guys, if you're not comfortable with 1%, it's okay. Risk the smallest amount possible. The smallest amount possible, guys, for forex is 0.01. For years, I risked 0.01 lots per trade because I had no idea what I was doing. I wasn't comfortable trading, so I didn't want to risk so much money. And thankfully, I did that. Otherwise, I would have lost even more money than I lost from trading. I lost thousands of dollars from trading, by the way, guys. Thousands of dollars from trading. Okay, so yeah, thank God I wasn't an idiot, right? Imagine if I didn't do that, I would have lost even more. That would have been even worse for me. So point blank period risk 1% of account per trade maximum. Now let's go to the other aspects of risk management. How many positions are you going to open every single day? Is it smart to be opening 50 trades a day, 20 trades a day, 10 trades a day? No, it's not. I can tell you right now it's not. The best day traders don't do that. The best traders only open up a couple of trades a day. 1 trade, 2 trades, 3 trades. That's it. As a beginner trader, you should only be taking 1 trade per day. Maximum point blank period. That is it. I don't care. Whether you listen to me or not, guys, what I'm saying is right. 1 trade per day. Because again, you have to think about this, guys. If you are allowing yourself to take 100 trades a day, let's say, do you really think, first of all, that the market is going to offer you 100 trades that are fantastic setups that you can make money from? No. Do you think the market is going to offer you 20 trades like that? No. It's only going to offer you a couple of setups a day. Maximum. If that. Some days it's going to offer you 0 setups. Now, what are the chances, guys, that those setups are going to be the exact same time that you're awake, that you're trading? Begs the question, right? So does that mean you're going to be trading every single day? Probably not. Now, here's the thing. If you limit yourself to 1 trade per day, you're telling yourself, I'm only going to take the best possible setup. And this is how you're going to avoid building an account. Because if you only allow yourself to take 1 trade a day and you see a trade and you know you shouldn't take that trade, are you going to take it? No. Because you know if you take that trade, you can't take any other trade. And if that trade doesn't look that good, and another trade comes along that looks even better than that, you're not allowed to take the second trade, right? Because you've already took your first trade. And now you're going to let go of a trade that was even better because you were too anxious. You had a feeling of FOMO. You don't want that to happen. You want to take the best possible setup. You want to take the cleanest setup, the one where you look at it and you're like, yes, I need to take this trade because it is going to make me money. Those setups will come. Will they come to you today? Maybe not. And on those days, you're not going to take a trade at all. Will they come to you later? Maybe. But that's the whole point. You wait for that setup to come to you. You don't chase the market. If you allow yourself, guys, to take 10 trades every single day, you are chasing the market. Point blank period. You are chasing the market, and there is no possible way you are going to make money. But if you allow yourself to take 1 setup a day, that's going to be the best setup out there. And when you know for a fact, people always tell me this when I give them this advice, they're like, how am I going to know it's the best setup possible? Because when you see the setup play out in real time, you're going to have no hesitation. You're going to say, yeah, you know what? I have 1 trade, and this is the trade that I'm taking it on. Guys, it's very, very simple. Here are the thoughts that are coming in the back of your head. If you think for yourself for a second that I'm going to take this trade, and you're about to take that trade, and you're like, I don't know. I don't know if I should take this trade. That's not a good setup. The best setups, guys, are the ones that you look at it and you're like, buy, sell. You don't even think about it. So until that sort of setup comes along, just don't trade. And when it does, you trade. And that's about it. Okay? 1% risk per trade, 1 trade per day. Now, the next part is going to be correlation. Okay, this is going to be a little bit more advanced, or maybe not advanced. Maybe this is for something like a swing trader. All right, let's say, guys, actually, you know what? Give me 1 second. I'll just actually pull it up. Okay, hopping back on the chart for a second, guys. What do you notice about these pairs? This is GBP USD on the right, and this is Euro USD on the left. What do you notice about these pairs? They're two different pairs. Euro USD on the left, GBP USD on the right. I'll give you 5 seconds and then write it down in the comment section. 5, 4, 3, 2, 1. Don't they look pretty similar? Don't they look correlated? Right? You notice? Look at this. Euro USD is going up for the most part. Pulls back. So does GBP USD. Goes up again. Pulls back. So does GBP USD. Has this pullback. So does GBP USD. Euro USD starts to go down. So does GBP USD. Now you'll notice the movements aren't the exact same. Correct? Right? You'll notice this was a very strong pullback on Euro USD. But on GBP USD, it wasn't that strong of a pullback. But relatively speaking, when one goes up, the other goes up. When one goes down, the other goes down. Correlated pairs. This is another type of risk, okay, guys? If you're taking a long position, let's say you're a swing trader. On Monday, you take a long position on GBP USD. On Tuesday, you only take one trade. On Tuesday, the next day, you see a long position on Euro USD. If you're risking 1% of your account per trade on both of those trades, you are now risking 2% on pairs that go against the US dollar. And that is bad. Again, now you might be wondering, Syed, what the heck? Why is that bad? Like, I'm taking one trade per day. I'm risking 1% of my account per trade. But correlated pairs, guys, you have to be wary of this. Both of those pairs, the reason why they're so similar is because of the fact that they are both based off the US dollar. Okay, so let's say you're taking a long position on the US dollar, on GBP USD and Euro USD. You're thinking that the US dollar is going to be weaker. Now, what happens, guys? What happens if some news comes out, right, and the US dollar suddenly gains strength? Well, then both Euro USD and GBP USD are going to go down. And if both of them go down, you might get stopped out. So you're going to get stopped out on both the Euro USD and the GBP USD trade that you took. Now that's 1% plus 1% equals 2%. Now, yes, those were two different pairs, and those were two different trades. But like I just showed you, they are correlated. So what's going to happen on one will most likely happen to the other. So is it a smart idea to be taking two trades on very correlated pairs? No. Why would you do that? Because if one moves, the other is likely going to move the same way. It makes no sense. You shouldn't be doing that because you're exposing your risk double. You've doubled your risk on trades that are going against the US dollar. So again, if something happens where the US dollar all of a sudden gains strength, you're going to lose 2% of your account. That's the way you should be thinking. Correlated pairs, again, can be very beneficial because if you take the trade and both of them win, well, now you just also double your gains, correct? But it's not always the case. We don't think about our winners, guys. We think about our losers. Why? Why is risk management so important? Because we can control our risk, guys. I can't control. You can control. The best day traders in the world cannot control how much money they will make on a trade. If I take a trade right now, I don't know what's going to happen to it. We know this, right? Take a buy position. What's going to happen to it? I don't know. But what I do know is that if price moves to my stop loss, I'm going to lose 1% of my account per trade. That is what I know. No one's going to debate me on this. And you know that too. If you manage your risk properly, if you put in your position size, you know that when the stop loss gets hit on this trade, I'm going to lose X amount of dollars on the trade. I'm going to lose X amount of percentage of my account. We can control the risk. We cannot control the gain. So correlated pairs is another form of risk management, guys. Make sure you are not taking trades off correlated pairs. 100%. If you take it on one pair, you can't take the second trade. Or let's say you get two positions open, right? Let's say you're on GBP USD and you're on Euro USD. Well, then cut your GBP position in half and then take 0.5% risk on Euro USD, right? So if you have 0.5% on GBP USD and 0.5% on Euro USD, well, now it's in total 1%. And that's perfectly fine. But to double your risk by taking two separate trades on correlated pairs is not a smart idea. Okay, so you're going over position size, right? You can find a position size calculator. Make sure you limit it to one trade per 1% of your account per trade. You've gone over trades, right? How many positions are you taking every single day? Make sure you try to limit it to one trade per day. And we've gone over correlated pairs. Again, only taking trades off one correlated pair or splitting a risk between all of the correlated pairs. Okay, you'll notice, guys, everything is very minimal. I'm not saying to risk 20% of your account per trade. I'm not saying take 10 trades per day, right? I always say this, in day trading, less is more. Do less, make more money. That being said, guys, that's it for this video. I hope you guys took notes. I hope you guys enjoyed it. Very, very important, guys. Heed my advice. I know what I'm doing because I've lost a lot of money and now I make money from trading. I know what I'm talking about. Whether or not you follow me is up to you, but it's definitely the right advice. So with that being said, guys, assalamu alaikum, Allah Hafiz, peace out.